Terminating, other than for electing termination, it says a partnership terminates when the following occurs. The business and financial operations are discontinued. The business is reduced to one partner, or 50% or more of the partnership interest change hands within a year, within a 12-month period. A couple of other types of partnerships, and we talked about a partnership. The word we'll learn down the road is a general partnership, where we're all general partners. We're going to learn in business structures about limited partnerships and then also LLPs, LLCs. What is an LLC? It's a limited liability company, and it's kind of like a partnership as far as tax purposes. It could be taxed as a corporation. It could be taxed as an individual proprietorship, Schedule C. Usually it's taxed as a partnership if you have more than one member. It says unless members elect otherwise, an LLC is taxed as a flow-through entity. If there's one member only, then it is more of a sole proprietor and goes to Schedule C. If it's multiple members, on a 1065, although it could choose to be taxed as a C-corp or an S-corp. Some advantages: it's considered an entity that is separate from its owners. It may sue or be sued, and we'll talk about a lot of these in business law. Some of the disadvantages: some states don't allow for it. An LLP is a limited liability partnership. When an LLP says it's kind of similar to a general partnership, it says here another form is that in which case all partners, depending on the state, have limited liability. It is like a general partnership in that all partners have the right to participate in management. Unlike general partners, though, they're not liable for the misconduct or negligence of others, which I'll expand on in a chart in just a minute. Although an LLP provides its partners limited liability, is taxed similarly to a general partnership. Taxed as a partnership unless they choose to be taxed as a corporation. If taxed as a partnership, a general partner, if there are any, is subject to both income and self-employment. A limited partner share would be reported as passive income on their Schedule E. Similarities and differences: formation, both require formal statutes. Both are easier to form than a corporation. Both give limited liability in some cases, which means it's formally created. Both require a certificate with the appropriate state, like certificate of partnership, limited partnership, and so on. An LLC may be formed with one or more owners, whereas a LLP requires at least two. Because an LLC is a company, you could have just one person. A partnership has to have at least two. Taxation: both are generally pass-through entities. Both report their operations by filing 1065 K1s. An LLP is always treated as a partnership. LLC could be a partnership or sole proprietorship. Or, as I said, both could form be corporations. That's usually not the case. They're usually partnerships. Liability: LLCs generally limit the liability of the members to their investment plus the cost for their own negligence and malpractice. LLPs are generally not liable for the actions of the co-partners, but are liable for the obligations and debts. So in one case, they're liable for their negligence or malpractice. In the other case, they're liable for their debts. So you'll see in this chart LLC, both formal creation, one person or more, limited liability for contracts and debts, unlimited for malpractice or negligence. They're either called an agent or a member, taxed as a partnership, or it could be Schedule C or corporation. LLPs, two or more people, limited liability for malpractice and negligence, unlimited for contracts and debts. When we talk about big accounting firms, what are they? LLPs. So in an LLP, they have limited liability for the other partner's malpractice and negligence, but they have unlimited liability for the contracts and debts of the partnership. So that's what's happening as far as the different formation or what the actual partnerships look like. Let's look at the tax forms before we actually do some problems and see if what we talked about makes sense. So we start out here with our 1065, and you'll see here your 1065, again, could be calendar or fiscal. When is the tax return due? 4/15 in a calendar year. Gross receipts, cost of goods sold, salaries, guaranteed payments. Oh, it's not separately stated. It's part of net business income. Okay. Then you've got cost of goods sold, stuff like that. Here we've got some more great information. Here's your Schedule K, which is the partnership's total, just like the K for the S-corp. These are all your separately stated items. Notice one of these is guaranteed payments. Now, why is a guaranteed payment separately stated here? Because it has to flow through to the partner's individual K1. Here's the balance sheet, M1, M2, just like a corporation. Then you got your K1. Here's your K1. What type of business is it? Here is the partner's capital account. So this is their capital. Remember, capital is not the same as basis. Here's their capital. Why? Because it doesn't include a percentage of their liabilities. Here are the separately stated items: ordinary business income, net rental bump, guaranteed payment. So guaranteed payment is separately stated on the partner's K1 who got a guaranteed payment. That goes to Schedule E. Your interest, Schedule B. Royalties, Schedule E. Capital gains, D. Collectibles, charity, Schedule A. Section 179, depreciation, 4562. And then on the next page, it tells you where to put it. Hey, where should it go? Here's where it should go. So again, it's important to see that. It's important to understand where the items go, where the items flow. So that's very important to understand as far as the flow of the partnership. So again, you can see here that we covered a lot of important stuff. Partnerships are a bit tricky, but if you understand what we just talked about as far as the flow, if you understand that, then you will understand partnerships as well. Okay? In a minute, we'll do some great questions on this.